So what we're telling our clients is this is a time to just put your seatbelt on and try to live through this volatility and sort of peer through the mist to recognize that fundamentals remain strong here in the U.S. And we think the Fed's going to remain very accommodative. So if you think about the economic data, we think that that actually gives the Fed the ability to be much more patient, if you'll pardon the phrase, than most investors thought a week ago. So the weak overall macro outlook allows the Fed to be accommodative. And in the meantime, we're buying companies. We're not buying GDP. So we're buying going concerns that have growing earnings, assets, and a lot of value.
I don't really see that the risks have risen materially just because we're still in a situation where a recession is pretty far away. We don't have excesses having built in the economy, neither in credit, neither in capital expenditure. So I really don't see a risk from that side of things. And at the same time, the Fed basically is ensuring that we remain in the sweet spot for equities, where there's enough growth out there to deliver solid earnings growth, which is a positive for the market. And at the same time, the withdrawal of monetary policy stimulus is going to be very gradual.
And certainly, I think this is a pause for the dollar. The reality is you've seen some positive surprises out of Europe, but we still believe this is a year where the U.S. will significantly outgrow Europe, and we will have a divergence in monetary policy between the U.S. and virtually every other central bank that will allow that dollar rally to continue.
I think it's too soon to buy the energy sector. We're not buyers at this point. If you can be really tactical and want to trade around it, then God bless. But, from our perspective, we don't have a great sense for where prices are going to bottom out. Inventory levels are incredibly high. And, this is not a market that's going to be trading just on supply and demand, even in a perfect, next couple weeks. So there's a lot of geopolitical events that we can't forecast, and we don't really know what supply is going to look like from the Middle East. So from our perspective, stay away. I think we have to wait a couple quarters.
First of all, we'll check out IBB right away, which is the ETF that broadly tracks the NASDAQ biotech index. It's up 40% in the last 12 months, and year to date it's up 20%. So that's going to tell us right away that this may not be a back up the truck and buy a moment. But when we back away a little bit and take a look and see what biotech is about, just what you were talking about, it's no longer Star Trek or Star Wars. This is a realistic alternative to the tragic losses in diseases that range from cancer, liver disease, Alzheimer's, as you just mentioned before, even within diabetes. Biotechnology is a solution. And we'd also say is not every stock in biotech has had a fabulous run yet this year.
Right.
We'd have to look at Amgen, or we would also look at Gilead. And for one that has had a great run this year, but over the last 12 months has not done so well, we like Intercept.